You're listening to episode number 20 of the Wellness Real Estate Podcast. Today, we're going to talk to Senior Loan Officer at Amerihome Mortgage, Michael Hoyt. I invited him to come on the show because he has some unique offerings that aren't offered by many lenders. Wellness isn't just about the home environment, diet, or exercise. Feeling financially secure, being able to afford a home, or being able to get into a mortgage if you don't have enough income but you do have other assets. This is all part of financial wellness. So, if you're an agent and you are wanting to learn more about how you can help your clients and offer them some great new loan alternatives, you're going to want to stay tuned. Let's grow. Welcome to the Real Estate Marketing Podcast, where we explore a unique strategy no one is talking about that will enable you to engage more people with authentic conversations about your business more often. And it's called Wellness Real Estate. Not sure what that is or how it can help you as an agent? Well, that's what this podcast is all about. In fact, Wellness Real Estate is growing so rapidly that it is projected to be nearly $870 billion by 2027. I'm Sheila Alston, and I'm your host. I'm also the founder of Healthy Home Media, where I help agents all over the country leverage this new trend in the industry to spark new conversations that will get people to listen to you and notice your brand. So if you're tired of spinning your wheels without any leads or sales to show for it, then stay tuned. I guarantee this podcast is not like any you've heard before. Welcome to the Wellness Real Estate Podcast. Hey, welcome, Michael. I'm so glad that you're here. Thank you so much for being on the podcast.
Thanks for having me.
Yeah, today we've got Michael Hoyt, and he's a senior loan officer at Amerihome Mortgage. And I just met you recently, and we got to talking, and you have some pretty unique offerings that aren't offered by a lot of mortgage lenders. So I just thought I'd bring you on the show, and maybe you could just tell us a little bit about them, because I know that the market's shifting. And so first, we want to talk about the alternative to a bridge loan. I know that not everybody knows what a bridge loan is, but this is even something different.
Yeah, definitely. Yeah, so thanks for the intro. So with a lot of times in our, kind of high-end market that we're in here in Southern California and in the Bay Area as well, where I do a fair amount of business, we run into a situation where a buyer may not qualify to purchase their next home without selling the current home. They may not make enough money to be able to carry the mortgage on both properties, but they have the down payment, or they may not have the down payment because it's tied up in the equity in their current home, and they may not make enough money on top of that. But the housing market has been moving so quickly that, with the available offerings that I've seen, most of my career would be what's called a bridge loan. And a bridge loan would be when they're really expensive. We don't actually offer them. They're kind of harder to find, but when you do find them, they're really expensive. The rates on those are, 10, 11%, and they might cost 2 or 3 points. So you're talking like a really huge cost to that, seller and buyer. Mm-hmm. And so there really hasn't been a great solution for that particular type of customer. And so having joined Amerihome back in April, we were reading through their guidelines and found that they have this really unique guideline. It's not even a special program. It's just in our guidelines. So there's no rate difference for it or anything. And so if the particular buyer does have the down payment, but they don't make enough money to, carry both mortgages, we just have you, the listing agent, prepare a listing agreement for their current home. And the home just needs to be listed within 3 months. And we then treat that current property as if it has been sold, which means that we don't have to factor in the total payment on that home into the debt to income ratio, which is really unique. Mm-hmm. If we run into a situation where the customer is income challenged and asset challenged, then what we would do, it requires a little bit of foresight. And so we would instruct them to go get a home equity line of credit from a local credit union or a different lender and get that in place with no balance on it. So they have that open line of credit. And then when you're able to get them into contract on their next home, they tap into that line of credit, move that money into their checking account. And then we use that same listing agreement that we would have you prepare on that home. And we, same thing, treat that entire payment as if that home had been sold, including the new payment on the HELOC. So yeah, so it's pretty unique. So I closed a few in the last month, and they were deals where, that particular realtor didn't have a customer that they could get a transaction done with. And in this case, you end up with two. So you get the listing and the purchase. So it's very unique.
Yeah, that's incredible. Is there a time limit on how long it takes to, I mean, the homes have been selling quite fast right now. So
yeah, there's not. It's so on the listing agreement, it just needs to be, the home needs to be listed within 3 months. So that's the rule, but it's nothing that, we follow up on later. I mean, really, it's just for us to be able to close escrow. It does put that, seller buyer in a position where they do have two properties they're going to be responsible for. Yeah. But, they probably won't start making payments on the new home for, a month, maybe 6 weeks. So that gives you time to prep their current home for sale, get it on the market. So they may only have one payment, maybe two, depending on how fast you get that, or 2 months where they have two payments, depending on how fast that current home gets sold. So they kind of need to be prepared for that timeline.
Right, because I know a lot of buyers or, a lot of sellers have been nervous about putting their home on the market because they've been selling really fast if they haven't found something else.
Right.
They want. But then
right.
they find something they want and then their house isn't sold yet. It's kind of this.
Yeah.
Thing, right?
Exactly. Yeah. And then they get put in a position where maybe they'd have to move their, when this solution didn't exist, they might have to move their family a couple of times. They might have to move into a rental, have you sell their current one, and then they have to be in the rental while they shop for their next home and then move again, so you have a lot of moving costs and things like that. So it provides a lot of flexibility.
It really does. And what are the points and fees compared to what a bridge loan was?
So like I said, it's just in our guidelines. So there's no extra fee for this. It's just, it's just a way that we would structure the loan. And so, our traditional jumbo products are in the, kind of mid to high fours on the 30-year fixed right now. Mm-hmm. Our ARM loans are in the kind of low to mid fours in that range. And there are 0-point options. And so, no extra cost for it. It's just a flexibility we have.
That's great. Mm-hmm. So we have, people from all over the country that are listening to this, and you said you're in California. Yeah. What if you're not in California or not specifically in Southern California? Can they take advantage of this?
They sure can. So I'm licensed in 15 states right now. When I get referrals in states that I'm not licensed, it's really easy for me to get licensed. So it's usually like a 2 to 4 hour class. And then I email the certification to our legal department and they basically flip on the switch. So I can, So it's like 24 to 48 hours for me to be able to lend in a new state. So
that's great.
Yeah.
Okay. And so, are there any you said that you just did this with a couple of real estate agents. And so are there any challenges that you have to be aware of or special things you have to get from the client to make sure that this can happen in a timely manner?
Yeah, that's a great question. So, number one, the HELOC piece with a different lender. So if their down payment is tied up in the current home, we want to make sure that they get that done first. And, home equity line companies we're hearing, kind of 4 to 6 weeks to get a HELOC done. So that's what I mean when I say it would require a little bit of foresight to get that buyer ready. But if they have the down payment and are just income challenged, we can get them ready right away. So there's that. And then there are kind of 2 additional requirements. Again, the listing agreement is needed. And then we have to verify that they have 12 months of extra reserves on the home that they're selling. So if the total payment on their current property is, $7,000 a month, we need 12 times that in reserves on top of 12 months of reserves on the new home. So, and we can use a 401k for that, or, so it's usually not difficult for people to come up with the additional reserves.
Oh, okay. Okay. Yeah, that's interesting. Mm-hmm. I wonder, have you had a lot of questions since interest rates are gone up or have gone up about, I just think now buyers are hesitant to make an offer. And if it's not that they're trying to flip a home, but they want to move permanently to a home that they love. I mean, what do you say to those buyers? Because if they're waiting for the market to go down, but the interest rates have gone up, it might not be a good idea.
Yeah. Well, when I'm introduced to each buyer, in addition to getting them ready for pre-approval, what I usually do is put together a lot of different payment scenarios that are really detailed. So they'll have, 4 different mortgage products, the 30-year fixed, 10-year ARM, 7-year ARM, and 5-year ARM. And then we look at purchase prices usually in 50,000 increments so that we can really zero in on what's comfortable and what's a push from their price range. Rates did jump up a lot a few months ago. Jumbo loans reached almost 6% a few months ago, and they have since come back down. So, many people aren't talking about that yet, but rates are now back down under 5. So they've come down a lot. The Fed is expected to raise rates again, maybe 0.5% in August. But usually when that stuff happens, it gets kind of priced in beforehand. We did see a little bit of a spike after Friday's jobs report came in. So, because the jobs report came in really strong. So when we see like positive economic data or stock market rallies, mortgage rates tend to go up on that type of news, and vice versa. So if their stock market has a bad day, usually mortgage rates get better. So
okay. So you were telling me also a little bit about as the market is shifting with these higher interest rates, that if sellers have to reduce their price just to get their home sold, market going down, that you have a unique offering for them.
Yeah, and it's so it would be selling price specific, and so what we're trying to do is educate sellers on not just, and realtors on not just going for the price reduction, because we can, your seller can do a price reduction for, let's say it's $15,000 on a lower priced home, or they can offer to pay points towards the buyer's loan, which ends up being about half the cost of that same price reduction to generate the same payment reduction for the buyer. So when it's the buyer, they're payment sensitive. So they're wanting a lower priced home so that their payment's lower. But if we can illustrate, okay, if we don't do a price reduction, but the seller is going to pay enough in closing cost credits to buy the rate down 1%, then you end up with the same net payment reduction. So it's just a way to save your seller some money and get the payment reduction for that prospective buyer. Yeah,
that's great. That's great news, because I think that sometimes sellers just feel the only thing that they can do is just reduce their price.
Right. And then, then it's kind of like a unique marketing opportunity too for that seller and you as the realtor, being able to, market not just a price reduction, because then that sort of makes it look like there's some more desperation there. And then those buyers may negotiate more, but instead offering closing cost credits to buy the rate down, that's like something that most people aren't offering. And it's sort of a unique thing, might catch their eye.
Yeah. So. And what a unique thing for agents to be offering as something when they're talking to try to go get the listing anyways, to say that, our we work with has these great options for you, so that I'm not going to come back at you and keep asking you for a price reduction.
Right. Exactly. Yeah.
That's awesome. Okay. And then there was one more thing you wanted to talk about.
Our asset qualifier program. Yeah. So we run into the situation a fair amount, especially in San Diego, where there's, a fair amount of retired people, but lots of money. So when we run into that situation where people's income might be lower because they've retired, or maybe they have a trust fund, things like that, but they have a lot of assets, we have a way to generate a lot of income off of those assets to be used to qualify for a mortgage. So, and the quick math on it is, if a customer has $1 million in assets, we're able to generate about $13,400 per month in income towards their debt to income ratio. So if they have $10 million, it's 10 times that. So you imagine what they can qualify for if somebody is has a lot in assets, but they don't have that income, and they might be discouraged to not apply for a mortgage or go buy a home because they're like, oh, I have Social Security coming in, and I have maybe like an IRA distribution that I take every month at minimum. And, their income might only be $5,000 or $6,000 a month off of that retirement, that fixed income that they have. But instead, we can qualify them for a lot more mortgage if they wanted, if they've got a significant amount of assets they've accumulated.
Yeah, that's incredible. And so the assets, they don't need to be liquid assets, or easily liquidatable? They can be other real estate or something?
Yeah, well, not in real estate, but it can be retirement. It can be stocks, bonds, mutual funds. It can be, and cash accounts like checking and savings.
Okay.
So, and that's a great question. So the different asset types. So cash versus investments versus retirement, they're all looked at a little bit differently for this calculation, and it's age specific. So if somebody is over 59 and a half and they have the bulk of their money in retirement, then I can use 100% of what's in their retirement. If they're under 59 and a half, that retirement balance is discounted to 70%. So if they have $1 million in their retirement account and they're under 59 and a half, I can use 700,000 of that towards this asset qualifier calculation. So
is it good for like a 30-year fixed mortgage or just for okay, great.
And any of our loans, 30-year fixed, 15-year, any of the ARM products, it works for all of them.
That's really great.
Yeah.
Because there are, people who are retired or people who, so none of if they did have other real estate, that doesn't count as part of their assets.
Correct. If they had like an equity line in those properties and then they, they would transfer that money into a cash account, then that would work. But since it's, real estate, it would have to be sold to be freed up. So generally it's just, your cash, stocks, bonds, retirement, stuff like that.
Yeah. I love this though, because I do think that sometimes if you're used to working at a big bank, or working with a big bank lender, you just think that there aren't these other options for buyers because they're pretty limited on what they can offer.
Yeah, definitely. And I've worked for big banks for a long time and worked in the correspondent world for a little while. Like Guaranteed Rate was my last company. And then coming here, we're owned by a bank in Arizona called Western Alliance. And they're they bought Amerihome a little over a year ago. And so they're on a path of growing our retail lending division. And they've got these really unique products that we've discussed. And so having worked for big banks, it was not a place I wanted to go work again. It's pretty cookie cutter, working at a big bank and lots of red tape and, not a lot of flexibility. And so been really happy at this new company. So
do you find that people that have to get some of these flexible, unique options are having to pay a lot more than someone who was going into a regular bank and getting something that was cookie cutter for everybody?
No, but the benefit of the big bank lenders is, they'll generally have like relationship pricing. So if somebody were to move millions of dollars to a Wells Fargo or a place like that, they'll get a rate discount. And that's something all the other places that I've worked, except for those, they don't offer that. Our company has that program in development and we're going to have it Q4 this year. So one of our sister companies is Torrey Pines Bank in San Diego here, you're probably familiar with. And our relationship pricing is going to be tied to them. So we're going to have that offering later this year. So.
Oh, that's so great. Okay. So then if there's an agent listening and they want to talk more about this specifically for one of their, how can they get a hold of you?
I have one number, my cell phone, 415-517-0900. Easy one.
Okay, great. And then do you have a website or Instagram or Facebook they could follow?
Yeah, definitely. My website is, it's amerihome.com/Michael Hoyt.
Okay. Awesome.
Yeah.
Do you use social media?
Loosely. My company is sort of taking over managing that for me because I didn't get into that as much as I should have, but they're working on it for me soon. So
okay, that's great.
Yeah.
Thank you so much for being on the show. I appreciate it.
I appreciate you having me.
Thank you so much for listening to today's episode. I hope you learned something new that will inspire you to think about your branding and how you can market yourself a little differently. If you enjoyed this episode, then you're going to love what I have for you because you don't need to wait to go get extra certifications or to grow and expand your network to get started attracting those new leads right now. You can simply begin by talking about wellness real estate trends and what you've learned on this podcast with others. This is pretty interesting stuff that no one has heard about, and I have all the tools that can make it even easier for you. Wellness Real Estate Magazine is a brand new wellness lifestyle magazine, and it's the only magazine that brings health and home together. We educate readers on industry trends and how to create a healthier home environment, written by industry experts around the country. And we have 3 covers to choose from: Wellness RE, Healthy Home, and Wellness at Home, so you can easily find one that aligns with your unique brand and messaging. These magazines are the perfect done-for-you tools that help you not only stay top of mind, but they educate and engage your audience, which positions you as an industry expert. Differentiate yourself and grow your brand the easy way. Learn more at healthyhomemedia.com.